So now we're going to move on to the third question, which is how can finance be used to transmute resources from extractive to regenerative? So all finance is about transmutation. And by transmutation, I mean the act of changing from one state or element into another state. So in conventional finance, investors seek to transmute risk into return. We're going to define that a little bit more deeply. But in solidarity finance or regenerative finance, we're going to explore the idea of redefining or really relocating risk and transmuting it into impact and power. So I want to start with our understanding of risk. So in the context of investing, what comes to mind when you hear the word risk? So think about that for a minute. There's a really traditional definition in finance, right? Which is that risk refers to the degree of uncertainty or potential financial loss inherent in an investment decision. So when I make an investment, risk is, am I going to get my money back or not? And traditionally, as investment risks go up, as they become higher risk, investors seek higher return to compensate themselves for taking the risk. Meaning, if I'm going to be the first money in a startup investment and I really don't know if they're going to be successful or not, then I might expect to have a bigger share of ownership in the company, or I might charge them a higher rate of interest on their debt. I'm trying to transmute the extra risk I've taken into extra financial return. If I'm a later stage investor, the model's proven, I might not have an opportunity to do that as much. So I want to explore the idea of what's limiting, what are the problems with that definition of risk? There's a lot of problems if we have an economics of relationship mindset. If we're in the economics of separation, makes sense. I'm putting money out. I want to win as much as I can for myself. But if I'm in relationship with the entrepreneur, if I'm an investor, I'm in a relationship with the entrepreneur or with other investors or with the community, then I might want to rethink my definition of risk. So one problem with it is that the definition of risk is centered entirely on the investor and not on the investee. And when we're investing in early stage entrepreneurs, especially folks that may not have equitable and fair access to capital or who may come from lower income communities who've not been bet on before, that distribution of risk, because I have capital and they don't have capital, seems to be quite limited. There's not a lot of mutuality and reciprocity there. So that's one limitation. Another is that only some risks are counted, right? Again, only my financial risk is counted. Long-term climate risk isn't counted. The risk of not investing in an individual or in a neighborhood or in a community is not counted. The risk of bias and the assessment of risk, which happens a lot, that risk is not counted. So we want to really relocate our notion of risk. If we go back to that two loops and you imagine that web of relationships under the first loop that's creating the emergence of the second loop, in the economics of relationship, we want to distribute the risk, relocate it throughout the system. Same inquiry when it comes to return. So in the context of investing, we think about what comes to mind when we hear the word return. So financial return, conventionally, is the money made or lost on an investment over some period of time. And again, same inquiry. The first thing is, it's located, that definition of return is me. I'm the investor, and I want to know how much money I'm going to make. That's the limiting definition of financial return that lives in the economics of separation. When we live in the economics of relationship, we then might say, I'm really interested in the return being distributed to those who are actually generating it, which is the owners and the workers. The people who are generating the surplus of the enterprise are the people doing the labor, the owners and the workers in the enterprise. So what does it look like to say that return should be distributed to them? What's the amount that the investors should get? What's the amount that the owners and the workers should get? That's only on the financial level. What about moving beyond the notion of financial return? What about the social return on, for example, improved health or education outcomes? What about the environmental return of sequestering carbon? Now, this is the heart of what people talk about as triple bottom line. Triple bottom line is people, planet, and profit. So the bottom line is how much profit am I making as an enterprise? The people piece is how much social return am I creating, social impact? and the ecological piece, how much is going back to the planet. But over and over and over again, even when we talk about impact investing and triple bottom line investing, we still measure financial returns and we separate out the impact measurement. So again, in the economics of relationship, in the context of complex adaptive systems, we want to integrate all those understandings of return, which means that we also have to actually understand, what do we mean when we say impact? Right? We talk about impact investing. So the definition of impact investing is impact investments are made with an intention to generate positive, measurable, social and environmental impact alongside financial return. Couple inquiries there. Who decides what impact means? What's sufficient? Who's impacted? These are going to be critical questions for you to consider in your own activities as fund managers or investors or people creating community-based economic enterprises. Also, this piece about who's deciding, where is decision-making? Where is power located? Conventionally, power is located in an investment committee with professionals. The invitation here is to recognize that there's an enormous amount of wisdom and intelligence throughout the ecosystem of relationships. And so this whole idea of relocating risk, relocating return, and relocating power in order to produce impact is the framework I'd like to invite you to consider. And part of this is that it all requires intersectional and systemic thinking. Traditional finance is the opposite. It's about breaking things down into their component parts. And it's effective often because it is reductionist and efficient. So it's easier to work with that approach. It's very hard to work with complexity. But again, being efficient, being reductionist is nothing like nature. It's nothing like us. It's nothing like life. And our economic system is made up of humans, and therefore it is a living system. And we have to work intentionally in that Cynefin framework, in that complex quadrant.